Hi, guys.
Hey.
Hey.
Hello.
There's people here. Now I need to figure out how to see if I had a memory. Those of you that have had me in class before, somebody's got their audio on. You need to mute the microphone on your end. Everybody got that? Okay, so for those of you that have had me before, you know I have a bad memory, which means it's going to take me a minute to figure out why it won't let me share my desktop. How come it's not letting me share my desktop? You guys see nothing but a black screen for me right now, right?
White screen.
Okay, white, black. How do I do this again? It says share my desktop and it's grayed out. I know we had this conversation last time about how bad my memory is. Chat, that's not it. Recording, it's recording. Participants, there you all are. How come it won't let me share my desktop? Share my desktop. It's grayed out. Why would it be grayed out?
Is it because someone else has their camera on?
Oh, I bet you no. I bet you somebody already got it. Who would have it? See, now you should be able to see me at least, which you don't want to see me. You want to see my desktop. So go away. No, Chris, we had this last time, wasn't it, that somebody had logged in first and had control of it and had to give up the control?
Yeah, I think it was me.
So how did you do that? Do you remember? Does anybody have a share my desktop and it's not gray? Because if you have a share your desktop showing and it's not gray, then somehow you need to take it back. Or somehow you have to give it up so that I can take it back. There, okay. I want to become the presenter, yes. So yes, somebody did that correctly, good job. Share my desktop, there we go. Okay. So now you guys, you can see the WebEx website? Yep. Okay, perfect. So who do we have here? Our sharing desktop participants. So 6 or 7 people here, that's good. So for those of you that can go away, close. Oh well, it stays where it is because I can't figure out how. Okay, so for those of you that have had me before, you know I'm in doctoral school, and so I am in the process of working on that as I'm doing this. So I've got a couple of nights of each session that I'm not going to be here. So that is why we're doing what we're doing tonight. So what I wanted to do is essentially we're going to do a brief version of what the real class is going to be like. And essentially let me switch here to so before I get started, I invited the online course students as well. Do I have any online students here? Or is it all to the face-to-face class?
I'm in your online class.
Okay, so you're going to have a little different experience because obviously you wouldn't have the opportunity to be in the lecture unless you wanted to switch. You're more than welcome to. So for everybody that's in the face-to-face, essentially each week we're going to go through 2 chapters of the homework, whatever homework was due by the beginning of the class. We would go through that, and then 2 chapters of the upcoming week's homework. So that's what we're going to do tonight. And
You're in?
sorry, I just heard a boop and thought I lost you. So that's what we're going to do tonight, and it's essentially going to be a shortened version of what each night of the rest of the term is going to look like. I want to start though, and this is especially why, Chris, I wanted to make sure that the online students were invited as well. I want to start with going through the syllabus and just go over the basic things and make sure if anybody has any questions, you have an opportunity to ask any questions about that. So we're going to bring this up, and I'm going to skip through, again, for those of you that have had me before, I always make the assumptions that students have busy lives and haven't necessarily always had the opportunity to read everything ahead of time. So if there's any sections that you have read and have a question of, feel free to stop me. Otherwise, I'm just going to zip through it because I don't want to keep you guys for the normal 3.5 hours tonight. I'm going to make it as 1.5, hopefully. So, no questions on the first page. Stop me if I'm wrong. And actually, let me see. I should be able to put the chat window up. So if you guys have, there you go. Hey, you guys were telling me what to do, and I didn't even see it. This, I don't need this. I can see it. There you are. Okay. So if you have any questions on the first page, let me know. If you have a mic, jump in. Otherwise, I'll see it here in the chat window. So second page, obviously, go ahead, somebody.
I was just turning the microphone back on. Sorry.
Okay. So second page, obviously, the important part is this is our textbook. I've had several people ask me about the text, and the 14th edition is okay. I actually fought the man and I lost. Up until this semester, I had been using the last edition, the 14th edition, and essentially the publisher said they couldn't get it to me anymore. I know it's still available for you guys out there, so if you're using it, that's fine, except there is differences in the way in the homework problem. So if you choose to get the 14th edition, you will need to, Dustin, is that you? Can you mute your mic?
Nope, sorry.
That's all right. So if you choose to use the 14th edition, that's perfectly fine, but you will need to acquire from someone, talk to one of your classmates, acquire from somebody the questions from edition 15 for each of those chapters. Okay, so that is the textbook. Obviously, the online course, this syllabus that we're looking at right here is for the face-to-face, but the syllabi are virtually the same. So this would be slightly different, this number right here, for the online. Again, this is going to be slightly different for the online because you don't attend. But for those of you that are in the face-to-face, we're going to have 5 sessions. It's an 8-week session. Again, like I tried to explain, both on the syllabus and on the introduction, it's a compressed 8 weeks. So the first week just finished, and now we're starting the second week, and then the last week, the 8th week, is a short week also. So there's only really 7 weeks, and I'm gone for 2 of them. So 5 weeks of attendance is where this first line item. Again, Kristen, for you just simply don't have an attendance one to worry about. Everything else for the online is going to be identical. 15 homeworks for the 15 chapters we're going to cover. 14 quizzes, 1 for each chapter, except we don't have a quiz for chapter 1. And then the final exam is going to be a comprehensive, and it will be online, just like each of the chapter quizzes are online. You'll do them, in your own time on Beacon Learning. So has anybody not had the opportunity to take a quiz on Beacon Learning before? Okay, everybody has. Good. So the way that will work is, you'll click on the assignment. Let me pull up the Beacon Learning. So you guys should have all seen this by now. So you click on here to upload a file. So there would have been a Word file for chapter 1 that you would upload for this week, due by the start of class today. and then an Excel file, and then pretty much the rest of the chapters, although I think chapter 14 might be Excel also, or excuse me, Word also. Yeah, see, chapter 14 is discussion questions, so that would be a Word file. Chapter 1 and 14, you'll upload Word files. The other 13 chapter assignments, you'll upload an Excel file for. For the quizzes, for the 14 quizzes, you click on there. Beacon Learning will provide you with the quiz. You'll answer them online. As it says in the syllabus, you're going to have a timed quiz with multiple attempts. Now, the exam will be similar to that, but you will just have one attempt on the final exam. When you go to Beacon Learning and you click on the assignment and open it up, it will tell you 3 attempts allowed. That's for, and I do this for the first, I think, 2 weeks. And then after that, I think you just have 2 attempts on the rest of the quizzes. This is to provide those that aren't as familiar with the way it works the opportunity to have it oops. And then after that, it would be 2 attempts up until the final. It tells you how much time you have for each of your attempts. And if you take multiple attempts, it's just going to give the highest grade for that one attempt. And it looks like many people already took that one. Good. So any questions on that, on the quizzes and the exams and the homework? I guess I really didn't get too much into the homework. Let me point this one out because some people who haven't had me before get confused in this. Here is I don't think I can highlight it. Let me see. It's not going to let me highlight it in that view. Select tool. Maybe it'll let me do it this way. Full screen. Yeah, see, when you're in full screen mode, it takes away the select tool. Zoom. I'm going to try to make it bigger for you guys. Everybody read that okay? So for those of you that have not had me in a class before, I provide you a little template right here of what your homework upload files should look like. So in your case, Jolene, you happen to be showing in the chat box, so it would be Lou J _ management 450 _ and then whatever chapter it happens to be, whatever homework it happens to be, and then the .xlsx. You know, if you're using Excel 2007 on, it would be an XLSX. If you're using 2003 or earlier, it would be an XLS. Okay, so any questions on the homework, quizzes, or the exam? Okay, so what's next? Class participation and deadlines. Again, for the online, for Kristen, for you, whether you're late or on time or late will be included in the grade for the assignment. And essentially, especially for those of you that had me last week in statistics, hopefully this term is not going to be as loosey-goosey. Essentially, somewhere in here, I'm looking as you guys get here. Where do I talk about late assignments? Course schedule, class participation deadlines. Class participation deadlines. Okay, there it is. So page 6. Late assignments will not be accepted unless earlier coordination with the professor has occurred. So for those of you that have worked with me before, you know that I try to be very accommodating and very understanding that life happens, but all of that is predicated on communication. So if you coordinate with me earlier and say that this is happening in my life, I will attempt to accommodate you. Especially this first week, I'm going to be lenient on it. I know some people had some issues with finding the book, etc. So, but in general, I don't accept late assignments. You will get a 0 if you don't turn it in. If you don't turn it in on time. Okay, so you had no questions on that. We talked about participation. This right here, the 3 I's, is kind of a boilerplate that I just include in all of my syllabi. For our purposes in this class, you're not going to be doing any writing, so you can pretty much ignore that writing section of it. But also, for those of you that have had grades from me before, I say that spelling counts even in math. So, you know, as you turn in these things, don't give me typos. This is expected to be college level work. You're all professionals, so, you know, take that into consideration. Even though it's not a writing assignment, I will still hold you to high levels of quality. We're not going to use TaskStream or Turnitin for this. Again, it's not a writing class. Unfortunately, for those of you that hate math, it's not a writing class. Here's our course schedule. Again, essentially, we're going to be doing two chapters a week. And then the exact dates are all available on Beacon Learning for all of these. Any questions so far? Okay, good. And then the rest of this is just boilerplate. If you have any questions on that, please feel free to let me know. Okay, so I will close the syllabus. Actually, I will leave it there in case we have to come back and reference it. Go away. Minimize. Okay, so here we are, chapter 1, chapter 2, blah. Again, Chris, for you, these resources are there for you to use as resources. I pretty much am not going to reference them for the online class, and if you don't use them, then it won't include discussions about some of these concepts. One of the things that
your audio is breaking up.
Hear from me throughout the class is the idea of I just moved, and that might have been enough to kill it. Can you hear me now?
Yeah.
Can you hear me? Okay. So yeah, I lost a little bit of internet. Okay, so for those of you that are in the face-to-face, these are the kinds of things that we will discuss. One of the things that I will stress often is the idea of value. And how do we measure value, and what are the things that are important? Throughout the textbook, he's going to often refer to stockholders and, you know, company valuation and things like that. And I will kind of reframe that in the sense of stakeholders instead of stockholders. Stakeholders meaning who all are we influencing, and in what ways are we influencing? So this Joshua Bell thing here, this clip right here is this world famous violinist in concert. You can listen to it if you happen to love classical. It's a half-hour long. It's amazing. This right here is a picture of a violinist, not a picture, a video of a violinist in the subway. I think it's 4 minutes long. And then this is a story essentially talking about violinists in the subway and what kind of value do people put on high quality. How important is it for us to pay attention to high quality? So again, that's an example of the kinds of things that I will throw into our discussions in the nighttime classes. It isn't necessarily in the textbook. When I teach this for the traditional undergrad, you know, the 18 to 20-year-old kind of range, they haven't had as much business experience. And for, you know, some of you, I don't know all of your background, some of you may be well aware with the way high finance works in large business, large commercial endeavors. If you're not familiar with it, this is kind of a campy little video, a little outdated. You can tell by their neckties and by the CRT monitors on the desktop. But it kind of gives a pretty good example of the types of things that a CFO is going to work on. One of the things, again, that I try to stress about this class is in a lot of classes, I actually say to the students, this is great, learning this is really important, but when you go out into the business world, you can forget it all because whoever you work for is going to teach you how to do it the way they want you to do it, not the way that this textbook author, not the way that Steve wants you to do it. Finance, though, it's one of those things that, hey, it really matters. You know, these skills that you're learning, they really matter. So if you wanted to see, you know, how people apply these kind of skills in the real world, that would kind of give you an idea. So again, those types of things are going to get thrown in there. Again, Chris, if you online students can take advantage of that, that would be great. Unfortunately, we won't have the opportunity to have those kinds of discussions like I will with the face-to-face students. Okay, so for a normal nighttime class, what I would do then is I would go over the Chapter 2 homework that we just finished, or if it was 2 previous chapters, I would go over Chapter 1 and Chapter 2, and then go into the lecture on the next 2 chapters, Chapter 3 and Chapter 4 for tonight. Again, these are the homeworks that are going to be due by the beginning of, so let's click on this and it'll tell us, if you're not sure, Tuesday, 7:15 at 6 p.m. So again, let's go back to here, the calendar, the main course room in here. This is the homework for the week. It's due by the end of the week. Now I'm confusing myself because which class are we in? This is the EU2 class. Okay, so Chris, for you, see how the week ends July 14th, it would be due for you by the end of the week. For the face-to-face students, the week is shifted until 6 p.m. Because that's when class starts. So, Chris, for you, when you click on that, it will say the 15th at 0000 hours, which is by the end, which 0000 hours is the very beginning of the day, the 15th, which means the very end of the day, the 14th. So again, essentially we're just looking at the definition of what the week is, and this is the homework that's due for this week, which means by the end of this week. Is that clear? Okay. So what I've got here is I've got the Chapter 1 and the Chapter 2 homework, and we can essentially, because we're doing this online, what I'm going to do is I'm going to defer to you guys. You know, and it's democracy, and if one person votes, they win the democracy. Do you want to look through all of these and see, okay, that was the answer to the first one, that was the answer to the second homework question, etc., especially on these discussion questions? Anyone have a vote? Do you want to see them? I'll step through them one at a time, or we can go on to Chapter 2. Okay, Rachel does not. Any other voters?
No, thank you.
Okay, we're done with Chapter 1. I will grade them, and if you have any issues with these Chapter 1s, I will, again, for those of you that haven't had me, what I do is when you upload your file, I will download it to my computer, I will grade it, anything that you have a mistake on or whatever, I will add a comment to it. So if it's a Word file, there would be a comment along the side in the margin. If it's an Excel file, there'll be a comment near the actual cell that the comment applies to, and I will add in the correct information there. Okay, so Chapter 2, for those of you that have that remember your accounting well, A, it could have been pretty easy for you. B, it also could be kind of frustrating because accounting is handled a different way in finance than it is in accounting. So for those of you that have been in management, the point of this course is not to teach you to be an accountant. The point of this course is to teach you to understand when your accountants talk to you. That's not the only point of this course, but that's something that we want you to be able to take away from this course, is that understanding of the accounting language. But that also means we look at it slightly differently. We have slightly different ways of describing things. So if you have a strong accounting background or you just finished your accounting classes and you look at Chapter 2, it might have been a little frustrating to try to bring those two worlds together. The third option is that A, you never took accounting, or B, it was so long ago that this was like a crash course in accounting and it was a little bit overwhelming. Hopefully we didn't have anybody in that status. But essentially, to encapsulate Chapter 2, and not to take tonight's lectures to go over what was last week's work. Essentially, to encapsulate it, we had 3 things that we needed to talk about. We needed to talk about the 3 basic accounting forms, which are income statement, cash flow, statement of cash flow, and a balance sheet. So those three concepts you need to be somewhat familiar with, or feel pretty confident about, because especially for the next couple of chapters, a lot of the information that we gather or that we utilize will be coming off of forms like that. So when we get into chapter 3 and chapter 4 in a minute, we'll be looking at some of those forms and saying, hey, how do I get this from that, etc. So for chapter 2, the 5 homework problems, what was it? 1, 2, 3, 4, 5 homework problems. Okay, now I got to switch back and forth. So, chapter 2, solutions. There we go. And chapter 2, problem 1. So problem 1 was we want to compute the earnings per share for 2012 and 2013. And so this is one of the fun things about the way that this text is presented, is they purposefully give you information in a, I don't know how to say this, roundabout kind of way, maybe, is one way to say it, because that's the way information is provided to you in the real world. If they just provided you a list that says, hey, compute the earnings per share, essentially we're just saying, hey, do some division. It's easy. But in the real world, that information you have to dig for, and then once you've dug for it, then you have to say, what tool do I have? Again, for those of you that just had statistics with me, actually doing the calculations wasn't that difficult. It was figuring out what calculation am I supposed to do, and where is this information? How am I going to gather this information together to make it look like the calculation requires? So this first problem, you can see there's a bunch of numbers in here. You might have numbers in there that don't apply. That's not a number that I need, and you can just ignore it. Or it might be a number that has to be transposed slightly to be of benefit to you. So that's just kind of a forewarning of the way this book is going to present information. In my opinion, and for those of you, a lot of my traditional undergrads, the daytime college-age students can't stand that. For those of you that have been in the work industry, that may, resonate a little bit with you about, yeah, I run into that every day at work. So hopefully that'll help to address any sorts of frustrations that you might have with that. So for this particular problem, I'm flipping to the back of the chapter 20. Okay, so most of the problems that we covered are pretty much the solution for how to do it is pretty much covered in table 2.1, which is on page 26. So we're just doing little portions of that. And so here they're saying, here's the $420,000. Okay, that's my earnings after taxes. So find earnings after taxes in table 2.1. It's line 10. Okay, so what's the next step? I have 309,000 shares outstanding. Well, what did we do here on table 2.1? So essentially, they did the exact problem for you on table 2.1 that you had to do in this problem, with a twist. So for year 2012, we had, earnings per share was $1.36, but the twist is now we issued 20,000 new shares in 2013, and earnings after tax increased by 30%. What was the new? Okay, well, I have to take 30% more earnings after taxes than I had last year. So the 420, I'm adding the 30% to. And let's see, and then the 309, I added 20,000 more to. So see how the formula here, I've got 309,000 was the shares I had last year, and I'm adding the 20,000 new shares. So the first year, I had 420,000 and 309 shares. The second year, I had 546,000 and 329,000 shares. So you can see my earnings per share went up between those 2 years. Is that clear?
Mm-hmm.
Thank you, Rachel. I can always depend on you. Okay, so I struggle with this. I told you guys in an online environment because I can't see your faces, and I don't want to belabor something that you guys are saying, oh, that's easy, why are you wasting my time on? And at the same time, I don't want to rush ahead on something that that somebody's confused on. So you're going to need to, stick your foot out there if you want me to stop. Okay, so problem number 5. This is also from table 2-1. So essentially all they're doing is they're saying, we gave you all of these different things, taxes, earnings per share, etc., and put them into good income statement order. So if you look at table 2-1, it provides you exactly the order that it should be in. So that's essentially all they did. They took all those words and they put them into the same order as shown on page 26. Questions on that? Okay, problem 9. Problem 9, guess which table that's from? Table 2-1. So again, what they've done here, they've given you a bunch of numbers, and they want you to put them that you just did in table 2-5. So in the order that you just did. And again, not just the order that's important, it's the mathematical operations that's happening, excuse me. So you're taking your sales and you're subtracting, so you're taking your 1.36 and you're subtracting your price of goods sold, 700,000. Well, let's see, let's put them in order. Here we go. You're taking your sales and you're taking your cost of and subtracting your cost of goods sold. So it's not just putting them in the order, it's also what mathematical operation did you do. So you can see here that I've taken 1.36 million and subtracted 700,000. And then back to table 2-1. The next thing that I took is I took my selling and anybody want to say that for me? Selling and administrative expenses. So where are they? They're 49,000. I subtract. Okay, we're done. What are they asking for? Take all your calculations to compute earnings per share. So when I get all done, I get an earnings per share of 354. Any questions on what happened right there? Okay, no questions. Wait, I hear somebody typing now. Let's see. Where does shares outstanding? Shares outstanding is what is the number of shares that have been.
Oh, what happened?
That's ownership. What's on, Rachel? Dang it. Can you hear me now?
Good.
You got me now?
I can.
Okay. Sorry about that. I just can't move, huh? Okay, so Jolene, you had asked where the shares outstanding goes. 104,000 shares outstanding. Essentially, it means there's 104,000 owners out there. Now, I might own 50,000, and Jolene might own 40,000, and Cinnamon owns 14,000. There's only 3 owners, but there's 104,000 shares of ownership out there. And so when we get to the bottom of this right here, our earnings available to common stockholders was 368,000, and we're going to divide it by the 104,000 owners. And that's what that earnings per share. There's 104,000 outstanding shares. There's 368,000 earnings. The earnings per share is earnings divided by shares. It's like miles per gallon. How many miles per gallon of gas? This is earnings per share outstanding, $3.54. Okay. Let's see, one more, right? Two more, 12. Okay, guess which table chapter 12 or question 12 comes from. Indeed. Table 2-1 on page 26 tells you everything you need to know about doing this one. So we sold $1 million in 2013. Cost of goods sold was 78% of sales. So again, the cost, they're not giving you, from page 26, the second line item there, 1.5 million. They're not giving you a 1.5 million. They're telling you, figure it out. It's 78% of 1 million, which means it would be $780,000. So when I scroll down here, the cost of goods sold is $780,000, 78% of the sales. Okay. S&A, selling administration, was 12% of sales. So when I get here down here to S&A, it's 12% of $1 million, or $120,000. Okay, so essentially we're doing exactly the same thing on this problem as we did on problem 9, except they throw in a twist. Every little problem, they throw in a little twist. So you need to do a little bit of math here to come up with the numbers that you need to fill in the values for your income statement. When you get down to the bottom, what were they asking for here? It's always good to know what they want to know. Compute earnings after taxes. Okay, so part B, increase S&A to 14% of sales. So essentially what you're doing is hey, let's spend some more money on marketing and see if we can more than offset that additional cost by selling, by getting more revenue from the additional sales. Okay, so by doing that, we got an increase of sales of 50,900. Okay, so it was $1 million, now it's $1,050,900. So we went through these gyrations and we got that extra $50,000. Our cost of goods sold went down because of the efficiency that she gave us. So where was that? Extra sales will reduce cost of goods sold to 74%. Remember, it was 78%. So that 74% has given us a lower cost of goods, blah, blah. So essentially the important takeaway from this isn't how to follow the bouncing ball of doing the math. The takeaway here is when you do something in a business world, measure it. I did this thing. How is it actually going to improve or change the way I'm operating, not the way my business is operating? So in this case, I made $56,000 after taxes. Then I did this cool new thing, and I made $69,000. So you can see I went up $13,000 in earnings after taxes. This isn't revenue. Revenue is sales dollars. This is sales dollars minus all of the costs that it took to get those sales. So that earnings after taxes, I made $13,000 more by doing that extra work that Ms. Carr had recommended. Any questions on that? Okay, the last one, question 19. Question 19. Guess which table, question 19, was all you needed to look at to see, or to figure out, excuse me. Yes. Table 2-1 on page 26 shows you your income statement. So what we're supposed to do is, we had earnings after taxes, so we already know line 10 on that table on page 26. We already know what that is. We know the number of shares outstanding, so we know line 13. The stock price was $42. That's good. And the stock declined to $27.80. The next year. So in year 2013, it was 42. In year 2013, it was 27.8. So the price to earnings ratio is discussed on page 27. And it isn't necessarily, in my opinion, very eloquently described there. But the actual words themselves help you to decode what they're trying to do there. Price to earnings. Price is the stock price. Earnings is your earnings after taxes. So the ratio of them is divide the stock price by your earnings after taxes. So here you can see in year one you had $436,000 with $200,000. Those are your inputs. Let's do it here. So your first year you had the 436,000 divided by 200,000, so your price to earnings ratio is 19.27. And they do this as a unitless expression, even though really you've got dollars over shares. It's $19.27 per share, but they do it as a unitless thing. It's just 19.27 is the P to E of the first year. 2014 happened, you didn't do as well. You only had $206,000 of earnings after taxes. The stockholders punished you, beat you around the head and shoulders, and your stock dropped from 42 to 27. Your price to earnings, however, went up. What that means is that the market really expects you to perform better. If your price to earnings ratio is increasing, it means people are paying a premium for your stock. Compared to if it was decreasing, then they think you're going to continue to go downward. You're not going to perform as well as an organization, and so your P to E value would be a lower value. Now, those are somewhat esoteric arguments. They're only very valid if you're comparing similar companies. Are they similar sized? Are they competing in the same industry, within the same market? Now I can compare them. So if I take Hewlett-Packard and Dell, and I compare the P to E of those two companies, it's a similar kind of company working in a similar market. So a comparison between their two P to Es, if one of them has a higher P to E, then it would mean the market is expecting that company to perform better than it currently is. So that's what that's showing right there, is even though the company took a hit and their stock price took a hit, their stock didn't get punished as badly as their earnings did. Any questions on that? All righty. So it is okay that you did not use it this time, but going forward, all of these types of homework problems, like I said, except for Chapter 1 and Chapter 14, you should be doing all of them in Excel. I need to be able to see the calculations that you've done. Again, for you statistics students, you know this. If you get the wrong answer and I can't see the calculations, it's just wrong. You know, if you do a typo, 6 minus 2 equals 3, because guess what? The 3 button is right beside the 4, and you hit 4, it's wrong. But if you do the calculations in Excel and I can see the work, then I can at least give you partial credit if you're close and you didn't quite get it or whatever. Also, that proves to me that you actually did it instead of finding an answer key somewhere and just copying down the answer key. So, go away, delete that. Okay, any questions on Chapter 1 and 2 before we go on to Chapter 3? Okay, so Chapter 3, essentially what they're doing is they're saying, how do we compare organizations? And this is my famous graphic that I use for how do you compare things. And so for those of you that love sports, you can wax eloquent on this, if it ever loads. There we go. How do you compare that? How do you say which one of those is worth more? How do you say which one of those is more valuable to the franchise? How do you say which one of those is more valuable to the league?
Number 23.
Really, in my mind, there's no argument. But different people would make different arguments about it, especially if you're from, LA or Miami. But that's the picture that I think is valuable here, is if you're trying to compare, Lenovo and Dell and IBM. Well, IBM isn't in that market anymore. Lenovo, Dell, and HP, and say, which one is more valuable? Or yes, I agree with you, sentiments. How do you do that? Well, you could say, I want to look at effective field goal percentage in the finals. I want to look at, how many MVPs. I want to look at all of these different things. These are different criteria, that's not the word I want, different statistics, different variables that I can look at and use those to try to describe defend why one company, one basketball player is a better investment. So when you start looking at it from a business perspective, essentially you're doing the exact same thing. You're looking at, LeBron Incorporated, and you're looking at MJ Corporation, and you're looking at Kobe LLP, and you're saying which one of those is a better investment for me. My job is to invest for my clients. Which one is going to be a better investment? You have different ways, you have different measures, and that's essentially what we're doing in Chapter 3, is we're looking at these different measures and saying which one of these companies do I expect to perform better. Does that make sense? Good, I'll take that as a yes. So, in this chapter, essentially they give us 13 different ratios that can be used to assess the health of a company. Go away. Thank you. So we're going to look at those different calculations and see what we can determine about what they tell us about the company. So that's the idea behind this ratio analysis and why we do them. We're trying to make comparisons between companies that might be difficult, that people might have different opinions of, and use something that's concrete to determine it. And not necessarily different companies. It might be year to year on our own company. We're putting together a financial statement for our company, and we want to show the stockholders year over year how we are performing. The other option would be if we're doing an investment, if we're a broker or somebody like that, and Merrill Lynch hired us to be the expert on natural gas pricing, and we look at how the pricing of natural gas changes year over year, or the factors that are incorporated and how we're going to predict the future. Magic 8 balls don't work, but we're going to try to predict the future based on these kinds of analyses. Okay. So these are the 13, and they're kind of broken down into, what, four categories. Okay. So the interesting thing about the way they're broken down, and hopefully this will actually help you a little bit in helping to remember them, is the profitability ratios always include the net income. Okay. The asset utilization ratios always include assets, et cetera. So there's always that kind of commonality. So when you're looking at these 13 formulas in here, look at what's the commonalities between them, and that'll help you to remember which, help you to kind of gather all of these 13 things together and understand the way they work together. Okay, so we're going to jump into, well, let's stop right here. So the purpose for these different types of ratios, the profitability ratios, we're trying to see, is the company performing adequately for sales, assets, and invested capital? Are we getting a good return on our assets? Are we getting a good return on our stockholders' equity? That's what that invested capital is. Are we generating the sales that we should be based on those two assets, the assets and the equity? Or again, remember back to Chapter 2 in the balance sheet. You've got assets on the left-hand column, liabilities in the top right, equity in the bottom right. So what we're trying to determine is, are we using the left-hand column well? Are we using the bottom right well to produce sales? That's the whole point of going into business. Is commerce is all about taking an investment and making it grow. I always refer back to the story in the Bible of the talents, the 2 talents, the 5 talents, the 10 talents, and the person with the 2 talents buried them in the sand. The person with the 5 and the 10 talent invested them. They took that money and they made it grow. And the master of the servant said, well done, good and faithful servant, enter into the joy of your master, for the 5 and the 10 talents. And for the 2 talents where they didn't make it grow, the master said, you're wicked and lazy servant. So the whole point of going into business is you're trying to make these investments grow. And again, I want to emphasize that we're talking here about stakeholders. We want to ensure that we're addressing all the stakeholders. Everybody clear on the difference between a stakeholder and a stockholder? This is the point where you say yes or no.
Yes, sir. Yes, sir.
Okay. So I won't belabor that point. But again, just to put a more, in my mind, a more complete, a more holistic viewpoint on it, you're worried not just about the bottom line and how happy are you making your investment guy, because you have customers, you have suppliers, and if your suppliers go out of business because you drove them out of business because you were requiring such perfect pricing, etc., then you're going to go out of business. Without suppliers, you're stuck, right? So you have to consider more than just how is my stockholder, how is my invested capital working out. Asset utilization is the exact same concept. It's how well am I using my assets? Do I have all of my money tied up in accounts receivable? If my customers aren't paying their bills, then I'm not able to use that money. My customers are using that money as kind of a free loan to them, and I don't have that asset available to me to make it grow. Same thing with inventory. If I've got inventory tied up, it's not making me money. It's sitting on a shelf, right, Chris? It's sitting on a shelf and it's not making me money if I'm not turning that inventory. So that's what these asset utilization ratios are doing, is they're saying, how well am I using all of these assets that I have? Liquidity, essentially, it's saying, how well am I going to be able to pay off my bill? It's the cash flow thing. Cash is king. So there's different ways of measuring liquidity that we'll look at here in a little bit, but the bottom line is how able am I to continue operations? Doesn't necessarily mean that the long term is rosy for me, but if I can't pay my payroll tomorrow, I'm screwed. Okay? And then debt utilization is that there's an old saying, other people's money. I call it opium. OPM, other people's money, opium, okay? If you're making your money off of other people's money, then you're not risking your own money. Does that make sense? So if you're not risking your own money, then you still have to make sure that you're getting a good return on the debt. So how well are you using the debt to create income? Okay, so I'm not going to spend come back here. I'm not going to spend too much time on all of these. I am going to open this up. Open Sesame. Oops, wrong one. Open Sesame. There we go. So this is an income statement for this made-up company, obviously, and we would use some of this information from the income statement to be able to calculate some of those ratios, okay? Here's the balance sheet. Remember, I was just talking about, here's traditionally, the left-hand column is the assets. Here, traditionally, the right-hand column is the liabilities and stockholders' equity. The top of this would be the liabilities. Here is the equity portion, common stock, retained earnings. This would be the equity portion of your balance sheet. Remember, the whole idea of balance in a balance sheet is that this number right here, come back here, page up. This number, 1.6 million, balances with this number, 1.6 million. So these financial statements is where you're going to get some of these values that you need to be able to do these ratio analyses. So I'm not going to spend a lot of time on each of these. You guys all have the formulas. The math itself is not all that difficult in my opinion. Stop me if you think I'm wrong, because I've been wrong once or twice today so far. Anyway, the math itself is not the issue here. The real issue, the important thing again, for you stat students, I said I didn't want you to be a statistician when you finished your first statistics class. You're not going to be. You're not going to be a CFO when you finish this class either. I want you to be familiar with the ideas, be able to look up the concepts and utilize them. There's too much in the world. There's too much knowledge in the world to be able to memorize it all and say, now I'm an expert. The important thing is that you can now be aware of what a profitability ratio is. You can go look it up. You can pull up, net income off of a income statement, and bada bing, you can make the calculation if you need to. So this is on page 60, profit margin, return on asset, return on equity. So those are the three ways we're measuring our profitability of our company. So if you guys have any questions on this, stop me now.
Hey, Steve. What page again?
Page 60.
Thank you.
Hey, Steve.
Yes.
Is it possible to get these slides? Like
I will be posting these slides afterward. Yeah.
Okay. Thank you.
No problem. Anybody else? Okay. Where did I just go? Okay, so the DuPont system, to me, again, this is a place where they could have improved. I always pick on the textbook authors. You guys know that. They could have improved a little bit on the way they handled this. Essentially what the DuPont system analysis is it says that we're going to look at combining different ratios and drawing a more full picture by combining these ratios. So for example, here what they're looking for is I want to make sure that I have a high profit margin. Okay, so that's the formula number 1 on page 60. We want to make sure we have a high profit margin, and we want to know that we have a good return on assets. Okay, so that's the assets turnover, which is essentially formula number 2 on page 60. So they're looking at both of those and combining them to say, how am I really returning on my assets? So that's that formula number 2. I'm looking at my profit margin, net income over sales, and my asset turnover, sales divided by total assets. So they're combining those two different factors that the DuPont system determines is really the important factor on return on investments. Same exact idea on return on equity. They're going to essentially look at what is my return on my investments, and so essentially what they've done here is my debt per assets, and 1 minus my debt per assets is my equity per assets. Again, think of your balance sheet. You got assets on the right, liabilities on the top. Assets on the left, liabilities on the top right, equity on the bottom right. So my debt per assets is the top right divided by the left. My equity assets would be the opposite of that, which is the bottom right, or 1 minus my debt to assets. Okay, so that's where this came from. The return on my assets divided by 1 minus my debt per asset is the return on my equity. Again, think of it as the balance sheet. Instead of looking at the top right, which was my debt, when I'm looking at the return on my equity, I'm looking at the bottom right. Okay? So that's what this DuPont system means. I think we just lost somebody. We did. Okay. So again, the DuPont system, you're looking at these different things, and then this is the operation, the mathematical operation that they're putting in. So if I take my net income divided by my sales, it gives me a profit margin. If I take my profit margin times my asset turnover, it gives me a return on assets. If I take my assets divided by 1 minus my debt per assets, I get my return on equity. So again, they're just trying to take a more complete picture of the way those two things are work together. So here is, to me, an interesting way of looking at it. You take two different companies, and essentially they're kind of similar. They both sell clothes, but obviously there's a huge difference between them as well. So you can look at the numbers that the authors have put together on those companies, and see, using the DuPont system, how they compare to each other. So if we go back up to here, you can see I take my net income, my sales, I come up with my profit margin. Take my sales divided by my total assets, I get my asset turnover. My return on assets is my profit margin times my asset turnover. So I take column A, column B, multiply them together. Does that make sense to everybody? So when we get all done, we look at it and say, Walmart is doing a great job on return on equity, twice as good. But here is the interesting thing. 72% on my return on debt. So American Eagle Outfitters has a lot of debt, and they're getting their return on the debt, which is not necessarily a bad thing. They're using other people's money. Here, the return that Walmart is getting is based on the equity. That's the stockholders. So if I went out and bought a Walmart share of stock, they're doing twice as good for me as an owner as American Eagle is. But American Eagle is doing a great job of turning debt. I got a loan from the bank, something. I'm turning that into my profit. Any questions on that? For how you compare those two companies? Okay, so the next section, or the next breakdown of ratios is the asset utilization. Remember, essentially you're just saying, am I turning my assets into income, or are they tied up in inventory, or are they tied up in accounts receivable? So that's what we're doing right here. Is we're saying, how quickly am I turning my accounts receivable into sales? So again, for those of you in the business world, this is bread and butter. You guys know exactly what this is all about. Are my customers paying their bills? Okay, that's how long is it taking them? If I have net 15 set up as my, you're supposed to pay 100% by the 15th day, or they get such and such charge, or they lose their credit rating, or whatever. Different companies would have different penalties for how they would address that. In this case, what we're saying is my average customer collection period is 36 days. That means my customers are getting a free loan where I'm not able to invest that money and turn it into dollars for the company. And then again, the exact same thing with inventory. How quickly am I pulling that inventory out and turning it into dollars? If it's still sitting in my warehouse, it's not dollars. So you can see Saxton Company. Remember, we started, let me scroll. Where is this fake company? There's the fake company. This is where these numbers come from. I take these numbers and I do these asset utilization ratios. Come on. Okay, so we're comparing Saxton to our industry, and we're saying, Saxton, you're sitting on your inventory too long. You need to fire your sales manager and get another sales manager that's going to go out there and sell your stuff, right, Chris? So, essentially, those are the types of things that you're going to do with your asset utilization ratios. Are you actually using your inventory, using your assets the way you need to? The other thing is this idea of my fixed assets. How many sales trucks do I have out there? Do I have too many sales trucks in running routes, and I'm not getting a good return on those trucks? Maybe I can combine routes. Maybe I can, Chris, you should be teaching this section right here for us. But we're looking at sales per fixed assets. I mean, any publicly traded company, I can compare those values from one company to another, and I can see how I am doing compared to my competitors, or how I'm doing year over year compared to myself. So again, liquidity, essentially you're saying, how can I pay back? So remember, on a balance sheet, you are listing your assets in order of liquidity. So cash would be on the top, and long-term properties and things like that would be on the bottom. Same thing on your liabilities. You're going to list on the top of your liabilities section the shortest term liability. Something that's due tomorrow goes on the top. Long-term, a mortgage, something like that would be lower on that. So current liabilities versus current assets, you're going to be looking at the top items on your balance sheet, on both sides of your balance sheet, and saying, do I have enough current assets to cover my current liabilities. Again, you're comparing yourself to something. It's all well and good to say, you know, I'm at 1.99, but that simply means that I have twice as much money today as the bills that I have due today. It really doesn't tell you very much about the future, and it doesn't tell you how you're performing unless you have a valid thing to compare it to. Okay, the quick ratio is a more stringent comparison of the same thing, and what that takes into consideration is the recognition that your inventory pretty much can't be used to pay your bills. You're not going to be able to go to the bank in general and say, sorry, I can't pay the lease on my warehouse today, so instead will you take some of these swim goggles, this surplus of swim goggles that I have in here, will you please take those as payment on my lease, or on my mortgage, excuse me. The bank is going to say, do not pass go, do not collect $200, go directly to jail. So this quick ratio recognizes the fact that you cannot turn inventory into money very quickly sometimes. And so really, you take that out of the equation, and you can see the comparison there. I still have the same $300,000 in current liabilities, but I have a lot less in current assets when I take inventory out. So this number looks a lot lower. How much money do I have? I have 1.43 times what my current bills are on hand. My checking account has $1.43 in it, but that's okay because I only have $1 in bills today. Any questions on liquidity? Do I still have anybody here? Are y'all dead? Nope. Hey, look, I got people.
Good.
Okay. So it's 8 o'clock. How am I doing on time? I'm on slide 18, and I think I've got 30 in here. So let's see if I can speed things up for you. So debt utilization ratios, it's the exact same idea. How am I turning my debt into assets? How do I have enough assets to cover all my debt? Remember 2008 when the housing market took a hit, and a bunch of people had $300,000 mortgages on $200,000 houses. So you had a $300,000 up here on the top, and you had a $200,000 on the bottom, and you had a 1.33. Oh no, you had a 1.5. 3 divided by 2 would be 1.5. It's really tough math. But anyway, you would have a 1.5. 150% would be your debt to assets ratio if you had a $300,000 house and only $300,000 mortgage on only a $200,000 house, like a lot of your friends and neighbors did in 2008 and 2009. That's not the condition you want to be in. You want to have more assets than debt, but remember, opium. You want to use other people's money, so debt is not a bad thing in industry. The world of commerce runs on debt. So again, one of the things that happened in 2008, 2009, and from Chapter 1 that we didn't even discuss tonight, one of the items that was covered was the Dodd-Frank bill in 2008 that talked about the controls on who was available to get other people's money, who was available to acquire debt, and how much harder it got to acquire debt, and the resulting impact that that had on the economy. Because if I am a business owner, a small business, I'm a contractor. Okay, I'm a housing contractor. I build residential single-family houses. I need to get a builder's loan to be able to buy the lumber to build the house. And if a financial crunch comes in, 2008, 2009, also the housing crunch, but if a financial crunch comes in and all of a sudden it gets harder for me to get loans, now I can't get a loan to buy the lumber to build the house, and the economy all slows down. So debt is a huge contributor to the overall operation of the economy. So don't make the assumption that you should have zero in total debt and 0%. That would be, the gold standard. It's not. But it's a fine balance. Every industry is different. Every individual organization would be different in how they optimally will handle their debt. But in either case, typically you need to be able to pay your bills. And especially if you go to the bank for a loan and they look at this ratio and they see that you're upside down, then they would ask some hard questions for you. So again, the math itself is not the easy thing. One number divided by another. You guys all have that down, I'm sure of it. So let's continue on. So where are we? We're on page 65 is where this table comes from. And again, what we've done is we've looked at those last things, those last formulas that we've just gone through, assembled them all onto a page. And what we're getting from this is kind of a thumbs up. Siskel and Ebert, thumbs up and thumbs down. Did I just date myself? Does everybody know who Siskel and Ebert are? You're giving a thumbs up and a thumbs down. How is Thaxton doing? Overall, look, we got a good. Overall, we've got some good things happening. We don't have anything that's majorly out of the range. And so, if I was an investment advisor and I'm looking at these, would I tell my potential client that says, "Hey, I'd like to buy some Thaxton stock"? No, run screaming. No, these ratios look pretty good compared to their industry, right? That's the idea. That's what we're trying to do is get a report card on a company where we're able to compare it to somebody else. Here's our report card on LeBron James Incorporated and comparing it to, you know, Hall of Famers. Okay, LeBron's not doing so bad actually, right? Okay, so you guys can all ring in now with the no, he's terrible. Can we go over the sorry sentiment? Yes, we can. Yes, God invented calculators on day 8. Okay, the average collection ratio period. Let's go back up to there. Where are we? Where was that sentiment? There it is. Okay, so the average collection period means I've got accounts receivable. So I shipped, you know, company A, B, and C. These are all customers of mine. I shipped all 3 of my customers stuff. And I sent all 3 of my customers an invoice. And I said, you guys need to pay this invoice in 30 days. Okay? But until I actually get the money back from them, it's showing in accounts receivable. So, you know, it was 100,000 for A, 100,000 for B, and 150,000 for C. Goes into accounts receivable. Now, that's what my average accounts receivable is. And I'm receiving an average of $11,111 a day into my credit department. That's I'm getting those checks every day to cover my accounts receivable. If that's how many I'm getting every day, then it's going to take me 32 days to pay off the $350,000 that has been outstanding. So day 1, after day 1, I have $337,900, whatever, $889 still in accounts receivable because I just received the $11,000. So the idea is the longer this number gets, the longer this 32 goes out in time, the more time my customers essentially are getting a free loan because that money that I had in inventory is no longer, you know, it's not money in my bank account that I can do something with. I can't go out and buy a new forklift for my warehouse because it's not in my bank account. It's in inventory. Now I take that inventory that used to be on my balance sheet and I send it to my customer. Okay. Now on my balance sheet it changes from inventory to accounts receivable. Still shows on my balance sheet, but it's still not money in the bank that I can go buy a new forklift for my warehouse with. Now my customer has it. 32 days later, I finally get that money into my bank account. Now I can buy the forklift. Does that make sense? How did they get the $11,000? They probably beat up street vendors. No. My customers are sending me checks for $11,111 on average on any given day throughout my accounts receivable time period. And again, it gets a little fuzzy because we're looking at it in an average kind of framework. You know, day 1 I got nothing. Day 2 I got $25,000. Blah 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 blah. But I get these checks on average through that 32 day time period. I've averaged $11,111. Really, in the real world, what you're doing is you're saying, how long until I get $350,000? Well, by the 32nd day, I get my $350,000 in. It's actually backwards in this calculation from the way it works in the real world. In the real world, what we're looking at is we know average collection period, we know accounts receivable, so I'm going to calculate my average daily credit sales. Okay, And the way we know our average collection period is we say, how long is it going to take me for me to get that $350,000? Okay, day 32, boom, I finally got my $350,000. Does that make sense? Okay. Now, where were we? No problem. So we looked at, essentially we gave a report card to Saxton on how they're doing. But we also want to look at this over the number of years. So we compare Saxton on one ratio over the years to how does the rest of the industry do. And so here's a second thing here's another thing that we're going to compare to. Hang on just a second.
Stop moving, Steve.
Okay, sorry, I'm back. I just had to update. All right, so what you're doing is you're comparing what we have been talking about to this point is a snapshot in time. On this year, this is what happened. Okay, well now what is valuable is we want to look at this over time. And again, put yourself in the position of you're a industry broker for Merrill Lynch and you're supposed to be the expert on this particular segment. Well, you're going to compare each individual company in that segment and the overall industry for the entire segment year after year after year. And so you can be able to track it, so you can be able to see what things, what little knobs have an effect on it so that you can try to predict the future about which one's going to be the best investment for your customers. So that's where these kinds of analyses can be valuable. Again, if you're the financial manager for your own organization, you would do something very similar. Any questions on that?
Nope.
Okay. So I'm not going to belabor this in the interest of time, but there's the example, 3 computer industries, blah, blah, blah. If you bought IBM stock in 1993, the end of 1993, you were very, very smart. And I'm saying that because that's when I bought my stock. Because look, you know, boom, it dipped, and then all of a sudden you start to perform better. So, you know, hindsight's 20/20, it looks great. But if you've done this kind of analysis right here, and you see a dip in an otherwise well-performing stock, look, well-performing, and then there's a dip in here, that's where you start to say, how do you predict the future? Well, I'm going to predict that these experts that have, you know, obviously all this brain power are going to pull out of this because I've seen this and this and this, and look, they performed. So I'm not advocating predicting the future, but when you see these kinds of things, in general, for those of you that watch the stock market, this is when the market panics and people start selling. And when people start selling, that's when bargains are available. So that's, again, what investment advisors will try to look at when you're looking at an industry is when is there a bargain? When are people panicking? And then that provides buying opportunity for investment. Okay. Impact of inflation. We'll get heavily into this in Chapter 9, so I'm not going to deal too much into it in Chapter 3. But essentially, obviously, for those of you that have been shopping, you know, in the last week, milk prices are a lot higher than they were in 1988. Okay, they're going to keep growing. See, so there was 1988, right? Milk prices were a lot higher in 1988. Everything in the world seems to indicate that they're going to continue to grow. But when I'm looking at financial numbers, they always give them in then current dollars. So if I'm looking at an IBM stockholders report from 1988, it's in 1988 dollars. And if I look at a stockholder report from 2012, it's in 2012 dollars. I can't compare those two together because the price of milk grew between 1998 and 2012, and so did the price of everything else. So for those of you that aren't familiar, this is an example of a corporate website where you can go and get all of that information. So this SEC filings, you can go to IBM's website, you can find all of their SEC filings for years. And you can go in there and you can look at all of these things, but you have to remember that those dollars are all stated in then current dollars. If you want to compare what they did then to now, you have to adjust the dollars. And again, we'll talk much more in depth on that in Chapter 9 about how you adjust those dollars. But for now, the important thing to recognize is that when you do these kinds of ratio analyses, these financial analyses, that they don't take that into consideration. They don't take the time value of money into consideration. Inflation is another example, is another essentially name for the time value of money. Inflation and the price of milk, it's all related to, over time, what happens to the value of money. Anybody had a comment there, I thought? Okay. So that's the impact that inflation will have. So we're going to skip over this. The other thing, obviously, is every organization is going to be slightly different in how they report their dollars. Excuse me. So if I'm comparing Dell and IBM, if they have different ways of reporting or different treatments of tax policies and things like that, and the example in the textbook, they report their extraordinary losses at a different time on their schedules. So based on this treatment of non-recurring items. This treatment of non-recurring items is, where are you putting this extraordinary loss in your income statement? Based on where you put that, it affects how your net income is going to look, but it also affects what your taxes are going to be, etc. So different companies might do different quirky little things with how they particularly do it. It's still, acceptable by GAAP, generally accepted accounting principles. It's still, hopefully they have auditors, KPMG, somebody coming in to audit their organization, and they're still using acceptable GAAP accounting standards, but they may report them slightly different from company to company. If you're trying to draw a comparison between them, it might make a distortion of those values. And that's it for Chapter 3. Any questions on that?
Nope.
Okay, let's try to get through Chapter 4 quick. Does that sound like a plan?
Sure,
Chapter 2. Thank you. Chapter 4. Home. Okay. So, like I've said multiple times, the problem is that we, as far as I'm aware, none of you guys have working crystal balls, right? Magic 8 ball? Nothing? What about that? Yeah, anyway, Zotar. Wasn't it Zotar on the movie Big with Tom Hanks? Nobody's got one of those either. So the problem is we can't predict the future, and yet one of the main goals of a financial manager or organization is forecasting for the future. At Northwest Christian, we try to forecast. We have to budget. What's our next year's budget? Well, it kind of all depends on how many students we get, right? How do we predict how many students we get? We're predicting the future. We're doing our best. That's what you have to do in the business world as well. Once you've done that, you're going to create what are called pro forma statements. And pro forma essentially means future or proposed or whatever. You're going to, instead of the 3 financial statements that we discussed in Chapter 2, those are backwards looking, or 2 of them are backwards looking. One of them is a particular spot in time. This is what my balance sheet is at this moment. For our pro forma statements, we're going to get those same 3 financial statements, but they're going to be pro forma statements, meaning I'm going to be looking into the future and saying this is what I expect them to be next year, or next month, or 6 months from now. So that's what we're doing with this financial forecasting. So we work backwards a little bit from the way we would do it if we were constructing current statements.
So for Performa, and again, this should be no surprise for those of you that have been in the industry, you're going to start with a sales projection. And you're going to, you know, lasso all of your corporate resources that are going to help you to project how many students are going to enroll this year, right? And then based on that, if you're in a production environment, you would come up with a production plan. In our environment, it would be, you know, how are we going to, you know, how many classes are we going to create for those number of students, et cetera. So let's talk production because that's a more familiar, probably a more familiar format for most of you. So if I'm predicting that I'm going to sell 1,000 units and I still have 100 units in inventory from last year, then I know I need to build 900 more units. That would cover my sales. Now, do I want to risk maybe not being able to supply a potential customer and chasing away that potential customer because I was so perfect, I was trying to be so perfect in my forecast? Probably not. I probably want to build 950, which would give me a 50, it's called safety stock, 50 safety stock, whatever. See, what I'm doing is I'm creating this chorizo breakfast burrito. No, I'm creating this production plan based on what that sales forecast is. And then from that, I create this income statement. This is what my sales were. This is what my cost to produce that sales was. This is what my GS&A, my general sales and administrative costs are. I take all of those out of there and I say, okay, here's what my income, my net income for that year was. Now, the next step would be I take that pro forma income statement and I use it in creating a cash budget. Today, I have to have cash. So what I was just looking at was a 6-month or a 1-year projection, but for my cash budget, I'm probably going to be looking at it month over month. So for month 1, what is my sales? For month 2, or excuse me, what is my cash level? For month 2, what is my cash level? Okay. Once I've got those, I take last year's balance sheet, I take my cash budget, my income statement, and I create my proposed balance sheet for the next year or the next 6-month time period or whatever planning period I'm looking at. Any questions on that? Okay, so why do we do it? Yeah, you guys all get that. So what I'm going to do here is I'm going to pull up, oops, not that, this spreadsheet right here. This is, so on page, I'm flipping, hang on. Chapter 4, page 98, right in the middle of the page, it says go to mhhe.com, blah, blah, blah. This file right here that you're looking at on my screen is the file that they prepared, that the publisher prepared for the rest of the tables throughout this chapter. So I'm going to spend more time probably on this Excel file and be flipping through the pages in the textbook and less time on the PowerPoints. But essentially what we've done, and I'm going to go back to our course room and show you, actually, let me close this IBM thing. Okay, so back here in our course room, I'm going to show you, there's a few things. Let me close this for a second. So let me turn this on, show that. Again, back to my first statement. I am going to turn a bunch of these on, and we will talk about these in class next week. Show. I'm not sure why that one's in there, but I think it's anyway. Show. From the titles here, you can see the gist of what we're going to talk about next week. I.e., this is what happened when I drove my Mercedes to pick up food stamps. This one is a little bit out of order. This I thought was funny, so I thought I'd share it. This is what I will refer to multiple times throughout this course, this budgeting financial plan. Essentially, let me open that. Essentially, this is an example, and what I've done is classy, get it? Class, E, bakery, E. So for the class, we're going to create a business. We're going to be a bakery business. And we're going to have multiple items: breakfast, pastry, bread, and we're going to have a dining unit. You can come in and sit in our lobby or in our dining area and eat. We're going to have a retail unit. We're going to have a wholesale unit, et cetera. So what we're doing is we're forecasting, and then et cetera, et cetera. I'm not going to spend any time to speak of tonight on this. I'm just referencing it now. I turned it on in the course room so that you can take a look at it. But it's the same idea as what we're doing here in the textbook. We're projecting for our company, Goldman Corp, that we are selling wheels and casters. How many do we think we're going to sell? What price do we think we're going to sell them at? And this is, it doesn't tell us, I don't think, in the book very clearly, but it ends up that this is going to be a 6-month forecast. So over this next 6 months, we're projecting $100,000 in revenue. Okay, so remember that number, it'll come back again. How many do we currently have in inventory? Well, we have this many, but we're going to sell this many. So clearly, I'm going to sell 1,000, I only have 85. I need to be able to produce more of them as well. And then desired inventory. I want to have 100 at the end. That's that safety stock that I was mentioning earlier. So I'm not going to create 1,000 minus 85 would be, what's 1,000 minus 85? 915, right? I'm not going to make 915 because I want to have 100 left over. I'm going to make 1,015, okay? So there's what I expect to sell. This is what I have in inventory. This is what I project that I'm going to produce. And here's what my unit cost for each one I'm going to be producing is. And then based on that units produced times the cost to produce them, this is what my total cost of production is going to be. Now, I will go through that again as slow as you want. Did that make sense to everybody? Or does anybody have any questions on that? One more time. Sure. Okay. So again, Goldman Corp, I've got only 2 products. We're making it easy. I only have to worry about 2 different things that I'm projecting sales for, that I'm projecting sale prices for, that I'm projecting production requirements for, or that I'm calculating production requirements for based on those sales projections, and that I'm projecting production costs. Okay, so for these 2 items, I got those 4 important things. How many am I selling at what price? How many do I need to produce at what cost to be able to make those sales? So that's essentially what all of these tables from page 98 through the top of 102 is going to be doing for us. So on this, again, this spreadsheet is available for you guys to download from the publisher. So for this first tab, tables 4.1 through 4.8, we're going page 98 through 102 in the textbook. So for those, we're essentially looking at just those 4 items: sales, sale price, sales units and sales price, and units produced and cost per unit produced. And we're taking all of those and we're saying my total cost production was $62,000. My total projected revenue from those sales, projected sales, $100,000. Total projected cost, $62,000. Okay? So then I take in how much was in my old inventory, how much is in my new inventory when I'm done, and what's my gross profit from those. Okay? So my ending inventory is going to be the, okay, so here's the cool part. When you guys get to this, all of these are linked. So this tab here, this is called a worksheet in Excel. So this worksheet, they're all linked together with formulas. So like here, when I say combine, this sum is adding together C37 through E37. I didn't mention when we went through the syllabus, I always make the assumption that you guys have come into this class familiar with Excel. If you're not, that's okay, but you have to ask me the questions. I make the assumption that you are familiar unless I hear otherwise. So stuff like how to enter in this formula, when you download this file from the publisher, you should be able to take a look at this formula and figure out how they're doing these calculations. And you need to be able to take the time to follow the bouncing ball, essentially, and go from there, where are we going from here? Well, here I added up these two. You know, where am I getting all of these numbers? You need to work your way through the worksheet and look at these formulas and go, ah, yes, I see we're adding the gross profit for each of my two products to come up with the gross product combined, okay? If you have issues with that, that's perfectly fine. In class, we can go over it, or you can send me an email to go over it. That's all perfectly fine. But I'm making the assumption that you're going to be able to follow those formulas unless I hear from you otherwise. So stop me if I'm going too fast on this. So when I'm done, I've got all of those things. I know how much I've got left in inventory. I know what my profits are, etc. Now I can fill in those blanks. Remember table 2-1 on page, what was it, 26. Essentially, I've done that exact same thing. What was my sales revenue? Well, see right here, this formula right here says look up at D6. So I'm going to scroll up to D6. There's where that number comes from. I've taken my forecast and I've thrown them into my pro forma income statement for revenue. Okay, what's my cost of goods sold? Well, there's the 61,000. The formula says look at F49. I'm going to go up here to F49. That's 61,000. There's where my total cost of goods sold comes from, and I'm going to plug that into my pro forma. So my income statement is going to end up looking very similar to table 2.1 or 2-1, excuse me, or on page 102, table 4.8, that's what we're looking at right here. Again, the only difference between 2-1 and 4-8 is that 4-8 is a projected income statement. Any questions on that? Okay, the next section is I'm going to develop a cash budget. So let me go to, actually we'll close this because nobody asked me any other questions about the syllabus. What am I looking for? Oh, I know what I'm looking for. I was going to go to this. Nope. This, there we go. And get caught up to where we are. Cost of goods sold. Okay. So the cost, oh wait, no, this is not the right place. Cash budget, there we are. So for the cash budget, essentially, like I said, instead of looking at a 6-month time, or 6 months all at the same time like we were looking at on the income statement, now I need to look at it on a month-by-month basis. So what we're looking at here is, I had $100,000 in projected sales, but how much am I going to be getting each month? So this is the projected breakdown of what revenue I'm going to be receiving. So based on that projected revenue, okay, let's go back to my spreadsheet now, because to me, this all gathers it in and presents it nicely. So here's what my projected monthly sales are. Remember, I told you that $100,000 would come back. So here's the sum of those 6 months projections. Guess what? That is table 4-1. What was my quantity, my sales price, blah, blah, blah. I was projecting 100,000. Well, when I come over here to my cash budget that I'm developing, I'm projecting the revenue for the 6 months to total up to $100,000. But you can see that I'm not projecting necessarily that it's going to come in at an exact same rate. Some months I'll get more, etc. I might have seasonal thing, and this is pre-spring break, and so everybody's buying the new swim goggles from me before they go on spring break, right? So I sell a lot more swim goggles in April before everybody goes on vacation in May. Whatever. I've got a seasonal product, and so it may not be a level, even $100,000 split across those 6 months. Okay. The other thing, and you'll have a homework problem like this, so pay attention to this. The other thing is I don't necessarily get all of that money at the same time. So I'm looking in the textbook at the bottom of page 102. A careful analysis of past sales and collection records indicates 20% of sales is collected in the month of the sale, and 80% is the following month. So remember, what's a February? That's hilarious. Aren't you glad I didn't type this, and so you can't hold me responsible? Let me fix that. February. There. Whew. Thanks, Bruce. So what that means is, excuse me, in January, I'm projecting $15,000 in sales. Excuse me. Only 20% of that is going to be received in the month that it was sold. The other 80% of it is going to be received in the ensuing month, okay? But for the month of January, I'm going to receive 80% of what had been sold in December. Because remember, I'm looking at this 6-month time period here, January through June. But my cash flow in January is going to include 80% of what I sold the previous month, right? So this 3,000 was the 20% of January sales. This 9,600 here is the 80% of December sales and ongoing. So let me insert shape arrow from here to here. So can you guys see that arrow? You're seeing 80% of January I'm collecting in 80% of previous month's sales in February. Similarly, 80% of that, I get there, blah, blah, blah. So again, when you guys do this homework, you're going to be looking at that exact sort of calculation. How much cash flow am I getting this month might have nothing to do with the sales for this month. Some of it might be 2 months delayed. I think you'll have a problem where it actually says some of it is 30 days, some of it is 60 days. What is my cash flow this month? That's what's critical. So there's my cash receipts, $12,600. How much did it cost me to operate this month? So big deal, I got this much cash in. Was it enough to cover my costs? So I've got different costs that are associated with the things that, excuse me, the things that I produce. So I did 1,015 units. Remember, we projected how many we were going to have to produce back here. Total production cost is right here. Production requirements, 1,015 is what we predicted we were going to produce of the wheels, and 2020 is what we predicted we were going to produce of the casters. We predicted what our cost per unit was, right? So here we're developing how much is it costing me to operate, essentially. So for that 6 months, and we are developing it as a steady state production. Even though our cash flow isn't steady state, see how we've got a lumpy cash flow, we're developing this as a steady state production cost. So for January, we're going to be at 2,800 monthly cost for labor, 2,800 February, 2,800 March. So here, this is called level production. I'm going to continue that each month during my 6-month forecast. Okay. My materials, however, let's go to table 413, which is on page 104, top of 104. We shall pay for materials 1 month after the purchase had been made. So again, that's exactly what we were talking about with accounts receivable. We sell it to our customers. They might not pay us in the same month. Same thing with our suppliers. We buy from our suppliers. We might not have to pay them until the next month. So in the case of what we're doing here, see, I bought materials in December that I'm paying for in January. I'm buying materials in January that I'm going to pay for in February. So when we're looking at our cash flow requirements for this month, even though I'm purchasing 5,732, it's only hitting my cash flow at 4,500. Does that make sense? Everybody following the way? Even though we're looking at what's happening in this month, it might be related to the last month's transaction or 2 months ago. Depends on, you know, the particular accounts payable, accounts receivable agreements that we have with our customers and suppliers. Okay, so the bottom line, we've gone through all of that. We've said here was what our total cash flow out per month during our 6-month time frame of, and then we scroll back up here to the top and we say, here was what our monthly sales was. Here's what our cash receipts are. Here's our money coming in. Here's our money going out. Okay, so we look at that and we say, am I making enough? So again, this is where you're going to follow the bouncing ball. Here's the formula, plus C12, or if I hit F2 right there, it'll show you plus C12. I'm going to scroll up here, C12. There's my total cash receipt, 12,600. Where did that number come from? 12,600 right there. This would be D12, E12, etc. So each one of these formulas is just looking at what we already calculated up above for our total cash in. Now here, you can see right here, here's what our total payments are. That's where these numbers came from. Here's our total payment right there. So we're just taking those numbers and putting it down here. Now here's where the rubber hits the road. Here we're cash flow positive. Yay, there was much rejoicing. Whoops. Now we're cash flow negative, cash flow negative. What happens if we are cash flow negative and we don't have a source of cash? Yes, you are correct. We go out of business. Okay, so we have to be able to cover that somehow. So how are we doing that? Here we have a monthly loan. So for those of you that have been in small business, you know the idea of a line of credit. So for that line of credit, excuse me, we are going to tap into that when we need to. So this month we were cash flow negative. We have what we want as an ending balance at any given time, a minimum of $5,000. So how much do we have to borrow to get us back up to that? Well, we were at $6,380. Okay, our beginning cash balance was $5,000. We were cash flow positive in January of $1,380, so we're at $6,380. Subtract $6,452 from that, we're at $72 in the hole. But we always want to have $5,000 minimum. So we've got to have $72 to cover that amount we were in the hole, plus $5,000 of ready cash. So we get a loan for $5,072, and now we're back up to where we want our minimum cash balance to be at the end of the month. Month 3 of our forecast, we're again cash flow negative. So we get down here, and we have to take out an additional loan. So now we've got a cumulative loan. We took our old loan balance, we added in the new loan amount, excuse me, to get us back up to that $5,000. Because we were cash flow negative. Now we come over here, we're cash flow positive. Guess what? We get to pay off some of that loan. Okay, so our loan had started at $50.72. Then we tapped in to our line of credit again, and now we're at $927. Excuse me. And now we made a payment of our line of credit, $44.79. And then the next month we're cash flow positive again, and we pay it off. But guess what? This last month, we're cash flow negative again, and we have to get another line of credit again. We tap into that line of credit. In theory, we've got an ongoing line of credit with our lending institution. So does everybody follow what we just did there? We took all of our projected sales from our income statement, and we turned that into a month-by-month, how am I going to float the business, keep my operations paid for? Does that make sense? Okay. Crystal, awesome. Okay, so the last thing then, thanks, Bart. The last thing then is that we will create the third one. Why would a company project a negative cash flow? Because, so for example, in the company that we were just looking at, we had projected a lumpy sales. Okay, again, it was in my silly example, we were saying we're going to sell a bunch of swim glasses in April prior to everybody going on vacation in May. But for many reasons, when you guys take offs with Dr. Berquist, you'll delve more into this. For many reasons, it makes a lot of sense for an organization to do what's called a level production plan. So that means that even if there's dips and valleys in how many I sell, I'm going to always produce at the same rate. Obviously, what that means is that my inventory will grow and shrink. So as my inventory is growing and shrinking, my sales are going up and down, but my costs are staying the same. So if my sales go down, my cost to keep stuff in inventory goes up, my operating costs stay the same, I'm going to be cash flow negative for that month. But that's okay because I'm projecting that in April I'm going to sell, almost twice as much as I did in March. And I can make up for that cash flow negative that I was in March by all the higher sales that I'm projecting in April. So I'm I'm making a business decision that I want to be cash flow negative. And remember, I had told you the idea of other people's money. If I'm not going to use other people's money, then that means I have to raise capital another way. Another investor, I have to do something. I have to sell an asset. I have to do something to come up with cash to float my operation, or I can use other people's money. And obviously, people study this and write doctoral dissertations on which one of those is better and why. Every industry is slightly different. Every organization is slightly different. Some people would want to have more debt. Some people would want to have more equity. But in either case, in this case, this cumulative loan that we're talking about, they're using debt as their means of financing the operation of their company. And as long as they can continue to do it at that kind of cycle and it makes sense and they're making, go back to chapter 3 and look at those ratios we're talking about. If they're making good profitability ratios, if they're making good return on assets and good return on equity, then using debt to finance the way you're operating your company is a good way to do it. That make sense? Awesome. Okay, still trying to rush. We got 8 minutes left. I think I can wrap this up in 8 minutes. 2 more tables. Okay, so essentially the balance sheet, you're going to do the exact same thing. We've got all of this information that we've put together on the income statement. We've got all this information that we've put together on the cash flow statement. And we're going to take the last year's balance sheet and we're going to update it based on all of those new numbers. So I had such and such. Last year I had, I had 5,000 in cash, and guess what? I have 5,000 in cash again because I made sure that I financed it with debt. So here's my notes payable, this 5886. If I go back here, guess what? 5886. There's my line of credit that my cash flow statement showed me I would need to have in my liabilities section of my pro forma. So last year I didn't have any line of credit being used. Here on this pro forma that I'm projecting for next year, I have 5,800. So that's an easy example of showing how I changed this one, updating it with the information that I did in my other 2 projections, my income statement and my cash flow statement projections. I've updated onto my balance sheet projection, etc. So again, download this spreadsheet, and you can look at these formulas and see where these updated numbers come from. And again, this is what I'm using for business purposes to project what my ongoing operating situation is going to look like. Whether I'm projecting that for stockholders or for the owner of the company, you could fire me for managing his 10 apartment complex because I'm not managing it well. Okay, I'm doing this to prove to him that yes, I'm managing it well. Whatever sort of situation, innumerable situations where I'm trying to get a loan from the bank, and so I create this. When we start talking about classy bakery, that would be the idea. We're creating a business plan that we would go to a banker and say, I need $250,000 and to finance all the ovens and everything to start up a bakery from scratch. And here's my 3-year projection. That's what this is doing right here. So one thing I want to point out on this formula, so you can see I'm here in cell G6. Let me zoom in a bit. You guys should have told me like 2 hours ago to zoom in because you couldn't read it. Okay, so zoom in and hit F2. So this says equals table 49. See this little, there's a single quote right there, and there's a single quote right there. That's referring to a different worksheet. So this is table 49 to 415. That's this worksheet right here. So this cash is looking at cell G57 on this worksheet. So I'm going to hit F2 and go over here and look at G57. See how there's a white border around that right there? Oops, no, it's this one right. Wait. It's this one right here. There, see that one that has a white border around it? This is cell, I can't point at my screen. Can you see me pointing at my screen? Yeah. See, this is cell G57, and that's where this number is coming from. So you can scroll down through each of these and you can see this one came from this worksheet, and I subtracted H9 from H7, these 2 values on that worksheet, etc. So you can look at these and you can see where I gathered information from the previous balance sheet here and where I gathered information from the previous work tab to create my ongoing pro forma balance sheet. Any questions on that? Everybody awake? Okay, this should help you with your homework. If you have any questions on the homework, please feel free to email me. I think, yes, all of you that are left in here are all in my face-to-face class, so I will see all of you at 6 o'clock next week. Again, just like today, we will go over these, the answers to these homework problems, just like we did tonight. This should give you what you need. I will download this. Oops. Why does it do that? There we go. I will download this. Let me scroll through this real quick, make sure I finished all this. Pro forma balance sheet. Oh, yeah, and then they had one last example. I'm not going to go through the example. You guys are already falling asleep on me, I can tell. And they gave an example balance sheet at the end. So if you guys have any questions on this, please email me. I do pretty much answer emails every day as far as I am able to. Any questions?
No?
Clear as mud?
Yeah.
Nope.
All righty, guys. Thank you for your attendance and your attention, and I will see all of you at 6 o'clock next Tuesday.
Thanks,
Thank you.
Steve.
Have a good night.